look to what Jerome Powell might say later on this week, what sort of response that might generate out of the White House, which has repeatedly called for rapid rate cuts, and also for equities. There's also the question, can the China rally continue? And more broadly, we're waiting on earnings this week from Walmart and a couple of other major consumer-facing U.S. companies. What are they going to tell us about the impact on the ground in the U.S. of President Trump's tariffs?
And of course, we continue to watch that incredible rally in the stock market, but also those moves in the bond space as well. Treasuries continue to lose ground. We have seen also inflation-linked UK 30-year yields hitting the highest 1998 or so. What are some of the catalysts right now that investors are watching? Of course, we mentioned Jackson Hole at the end of the week as well, but it seems globally investors are just more cautious about taking duration risk at this point.
Yeah, well, there are a couple of things, on the table today that could add to that aversion to duration that you were mentioning. First of all, that is actually one thing that is trickling out surrounding the Russia-Ukraine situation, which is these reports yet to be confirmed that part of what's going to go on is that Europe is going to step up in funding Ukraine's purchases of U.S. arms. It's been talk of $50 or $100 billion or euros. It's all a little bit unclear, but that could add at the margin to the pressure that's helped to drive up German yields and some other yields in Europe, because governments are going to have to borrow to fund those purchases. So that is one minor concern for the bond markets coming out of the talks. And in general, bond markets are wary because there's so much coming. Speaking of supply, that's the other thing we've got to look at today, which is there's a couple of debt auctions coming out of Japan. The 1-year bill auction, which normally doesn't get too much attention, but might. If it's a poor one, that's going to boost the pressure on the BOJ to consider rate hikes sooner rather than later. Meantime, a little bit after that, we get the 20-year sale of JGBs in Tokyo. That looms as a potential point for not just Japanese bonds, but for global bonds. In the environment you mentioned where yields are rising, especially toward the long end. 20-year sales, both in Japan and the US, have been fraught on a number of occasions over the past few months. This one looks like having the potential to be even more so, given going on, given too that, as my colleague Mark Cranfield was pointing out yesterday, anybody who bought 20-year bonds at the last handful of sales is underwater, which means the prices are down since they bought. So the question is, how many more times are investors going to be willing to go to that well, seeing there being losses pretty rapidly after they buy? So if we get a weak 20-year auction in Japan, that will send yields up further out the curve in JGBs and put more pressure on treasuries, and then later on in the day on European debt.
Yeah, the trickle effect we could see again from Japan to the other G10 debt markets. Garfield, thanks so much. Garfield Reynolds, who leads our Markets Live Asia coverage. More ahead on the Asia trade. This is Bloomberg.